So that brings us to objective number 6. Let's prepare journal entries for manufacturer's job costing. Okay, just as we've discussed before, we have our raw materials. They're going to be purchased and pushed into inventory. So we have raw materials inventory. When they're being pulled from inventory and put onto the production floor, we will consider that to be work in process. So the work in process will be the jobs that we have on the factory floor. We've just demonstrated how those costs can flow through the jobs. We're going to actually add to these jobs direct labor. So we saw how that was going to be. And then we're going to also add to the costs an allocation of MOH. We demonstrated how that's going to work as well. So we're going to take our raw materials, we're going to add the direct labor and our manufacturing overhead costs. All these three are going to come into the work in process. Once the item is finished, it will go into finished goods inventory. And then when it's shipped out and sold, it's going to go to the cost of goods sold. Okay, so as an example here, let's take a look at the purchase of raw materials. So let's assume that Life Fitness ordered and received $90,000 of raw materials during December. So the journal entry for that purchase is going to be a debit to raw materials inventory for $90,000 and a credit to accounts payable for $90,000. So raw materials inventory, that is an asset. So under the asset section of our accounting equation, we'll have raw materials inventory. And we're going to debit it for $90,000. Now $90,000, just to have the offset to that is going to be accounts payable. So we'll put that, that's a liability. So the credit's going to be here too. And just for kicks, we'll go ahead and, so that we can tie these numbers together, we'll put a reference of 1 because that's the first journal entry. There's no reference number here, but at least that'll help us trace. All right. The next transaction that will occur is the use of direct materials. Now we're taking raw materials out from the warehouse in the back of the manufacturing plant. We're pulling it out and staging it to start the production process. The way it gets pulled out is through the requisitions, so accountants get the requisition information and they record the journal entry. So in this case, we're going to go ahead and debit work in process inventory and credit raw materials inventory. Okay, so we're going to debit work in process inventory for $112,000. So we create an account called work in process inventory. Mind you, that's still under assets. So $112,000, and we're going to credit raw materials inventory. Now what this must assume, I'm going to put it down here so that we don't get too confused. That must assume that we have a beginning in it, because you can't add it and then end up taking out 112,000. You'll end up with taking out more than what you had. So you had to have a beginning balance, whatever that is. But it's not referenced in the textbook. But I just want to make it clear to you that the removal of $112,000 means that we had to have had a beginning balance here. I guess I could put in a beginning balance. Let's just go ahead and do that. Call it BB for beginning balance. So just that it helps us make some sense. Let's assume that we started off with $50,000. So we're going to put 50,000 there just so that it helps us make some sense. We added 90, so that means we really have $140,000. Now we're taking 112. Now that makes a little bit more sense. And we took $112,000 out of raw materials inventory and we put it into work in process in inventory. Now, again, these are all assets. In fact, these are really going to be subsets of one account called, a large account called inventory. But we have details of this going on so that we're tracking everything that's flowing through inventory. Now, in our raw materials include some indirect materials. So let's assume that Life Fitness used 2,000 of the indirect raw materials during December as well. We're going to create an account called manufacturing overhead. We're going to debit manufacturing overhead for $2,000. going to be number 3. And we're going to credit raw materials inventory for $2,000. So 140 is what we had. We took out 112, put that in work in process. 2,000 we took out and put into manufacturing overhead. But what we put into manufacturing overhead is simply the indirect materials. Okay. Assume that Life Fitness incurred 30,000 of direct labor on jobs. 30,000 of direct labor on jobs. We're going to go ahead and assign 30,000 to work in process. So that's number 4. So 30,000 will go into work in process. We'll create an account called wages payable, and we're going to credit wages payable for 30,000. Make it a little bit smaller so we can see the entire picture here. 30,000 charged to work in process inventory, and 30,000 credited to wages payable. Assume that Life Fitness incurred 13,000 of indirect labor on jobs. So we're going to put 13,000. Let's make this number 5. So 13,000 goes into manufacturing overhead. That's a debit, and the credit is going to be 13,000 to wages payable. Assume Life Fitness incurs other indirect manufacturing costs, such as plant utilities, plant depreciation, plant insurance, property tax. Everything is listed right here. It's broken down on this slide, but it's going to take me forever. So I'm going to, instead of crediting all of these accounts, I'm going to just put everything under accounts payable. That makes it easier for me to put on the T accounts. So $10,000 is charged to manufacturing overhead. We know that the reality is that many of these accounts will be credited, but I'm going to make it simple for us. I'm going to put all of the 10,000 into an account called accounts payable. Okay, so I have the accounts payable. I'm going to go ahead and charge this number 6. $10,000 goes to manufacturing overhead, and $10,000 goes to accounts payable. And really, we know that it could be accounts payable, accumulated depreciation, all of these accounts. But to make it simpler, we just put it into accounts payable. Now, we've already gone through that process of understanding how we came up with the predetermined rate of $16. So that shouldn't be much of a discussion. However, let's assume that job 603 used 500 of direct labor hours, which we saw in that job record earlier as well, and that job 604 used 1,000 direct labor hours. So if we have a predetermined overhead rate of $16 per hour, we're going to compute how much gets allocated to each specific job. So as an example here, $16 times 500 is 8,000. And $16 times 1,000 is 8. So the total amount of allocated to work in process is $24,000, and the credit is going to be to manufacturing overhead. So this will be number 7, $24,000, and then we're going to credit 7 and $24,000. Now I'm going to remind you that this was based upon estimated numbers that we came up with the $16 per hour. This is an actual, this is what we came up with before the year even started. So what do we know? We know that there's a very good chance that what we're actually, it's almost definitively, because there's no way you could be that precise, that what we're allocating is different than the actual. Hopefully it's not off by much, but let's hope that we're reasonably accurate. So 24,000 into work in process, and 24,000 taken out of manufacturing overhead. Let's assume that job 603 had a total cost of $58,000, and job 604 had a cost of $108,000, so both were completed. So we're going to take those two jobs and add them up. We come up with $166,000 of total cost. We're going to put that into another inventory account called finished goods, and when they're finished goods, we can take those costs out of work in process. So let's do that. Let's create another account called finished goods. This is an inventory account as well, so this is going to be 8. So we're putting $166,000 into finished goods. And we're going to take out of work in process $166,000. Now, finished goods is still an asset, so all of these are still under assets. We're just moving money out of work in process and charged it to finished goods, $166,000. Let's assume Life Fitness sold 40 cross trainers from job 603 at a price of $14.25 each, and all 60 treadmills from job 604 at a price of $2,500. So we need to run those numbers. We have 40 cross trainers at $1,425 each. So let's do the math. 40 times $14.25. Then we need to do the math for the 60 treadmills at $2,500. We're going to do this multiplication, add the two to come up, and we should come up with $207,000. Now, we sold it. It doesn't tell us in the description here, but we can assume that it was all sold on account. So the debit's going to be accounts receivable. The credit is going to be sales revenue. This is what we sold it for. Whenever we sell units, if you recall from our financial accounting, whenever we sell something for a merchandiser, there are two journal entries that are going to have to be recorded. The first is the sale. This is the recording of the sale. We have another entry that we still have to do, but first we're going to record the sale. So let's do the recording of the sale. So we're going to go ahead and create an account called accounts receivable. It is an asset. We're going to put it at the very top simply because in most cases receivables are going to be above inventory. So we still have all our inventory accounts that we used earlier. But now what we're going to do is we're going to create the sale. And it looks like we sold it for a total of $207,000. So let's plug that in. That's a 207,123. $207,000 is debited to accounts receivable. The credit, the corresponding credit, is sales revenue. So that's under equity. We're going to put sales. So that records the actual sale of the units, the actual sale. If you dig deep back into your financial accounting, you'll remember that there's actually a second entry that has to be done. And that is, we've got to take the cost of the units that were sold and pull it out of inventory and charge it to the account called cost of goods sold. So continuing from the last example, a second journal entry is needed to record the sale. From the job cost record, we know that each cross trainer from job 603 costs $1,160 to make, and each treadmill costs $1,800 to make. We got that from the job cost record. So now we book the journal entry. So we know we have to take 40 units and multiply it by $1,160 for job 603. That's the cost of the units. Then we're going to add the 60 units that we sold and multiply that by the $1,800. We'll take that product plus the product of the 40 units and add those two together. That's our total cost. That's going to be charged to the cost of goods sold. That total cost is $154,400. So let's book that. Okay, so our cost of goods sold is going to be charged $154,400. $154,400. And then we're going to credit finished goods. Oh, by the way, that's going to be, let's go back before we do anything else. Let's make this number 9 here. For the sale, we're going to go ahead and use number 9 to record that journal entry. Now for the cost of goods sold, we know that $154,400 is going to be charged. Since that's really part of the same entry, we'll go ahead and refer to number 9 on that. $154,400 is charged to the cost of goods sold, $154,400, and then we're going to credit finished goods inventory for the same amount, $154,400. That's number 9. So now we have the recording of the sale of $207,000 and the cost of goods sold of $154,400. But remember that $154,400 includes costs that were allocated from manufacturing overhead. Allocation means that may not be perfectly exact right now because it was based on estimates. Okay, let's move on to operating expenses. Assume Life Fitness incurred $20,000 in salaries and commissions, $3,300 for office rent, and $9,400 for advertising. All of these are debits to operating expenses and credits to salaries payable, rent payable, accounts payable, etc. We're going to simplify this transaction and just sum all of these up. We're going to just create an account called operating expenses. And those operating expenses sit under equity. And it appears, let's see, we're talking about $20,000 plus $3,300 plus $9,400. So the total of all operating expenses, including salaries, rent, marketing, come up to $32,300. We could break it down here in more detail, have more T accounts, but I think you got the gist of it. And then the credit was to salaries and commission payable, rent payable, and accounts payable. Let's just go ahead and put this all again into accounts payable to make it simpler for us. So we're going to charge our operating expenses, $32,700, and we're going to credit accounts payable for $32,700. Let's go back to our instructions here. Now, here is the closing manufacturing overhead. So we can go and look at what our manufacturing overhead account looks like right now. So it appears that our actual costs, if we add up our actual costs, 2,000 plus 13 plus 10, we come up with 25,000. But what we actually allocated was $24,000. So what does that leave us with? Debits of 25,000, credit of 24 really leaves us a balance of $1,000. 1,000 debit. That means our actual costs are greater than what we allocated. Our actual costs are greater than what we allocated. Well, if you think about that, that means that what we allocated to the jobs was not enough. We underallocated. If we underallocated, that means we've got $1,000, and we know it's underallocated because it's a debit. Debit is an expense, that's a cost. We underallocated. So we have to get rid of that $1,000. So what do we do with it? Well, the simplest, we've got various alternatives, but the simplest way is, let's just take that $1,000 and charge it to the cost of goods sold. Let's do it. The last journal entry, 1,000 is going to be charged to the cost of goods sold. Cost of goods sold, we're going to have an added $1,000 cost, and then we're going to credit $1,000 to manufacturing overhead. After making this journal entry number 11, if we want to add up all of the debits, that's 25,000. 2 plus 13 plus 10 is 25. That's 25,000. And we add up our credits. That's 25. The balance now in manufacturing overhead is 0. We were off by 1,000, but we made that adjustment. And once we've made that adjustment, we've charged the cost of goods sold that $1,000. That was more cost than what we expected. And now our manufacturing overhead account is now 0. So the income statement now will show sales revenue, $207,000. Mind you, all of these transactions were for 1 month. So that means we should be able to see our T accounts that way. Yeah, T account was 207. That's what's going to be listed as sales revenue. The cost of goods sold is $155,400. Well, what is the balance here? Let's go ahead and compute it. Balance, $155,400. That's our debits, cost of goods sold. We take our sales revenue, subtract the cost of goods sold, and we end up with a gross profit of $51,600. Our operating expenses total $32,700. There we go. That's the debit, operating expenses. And from there, we can compute our operating income by taking our gross profit and subtracting our operating expenses. So our operating income is $18,900.